And good morning once again to all of our options traders out there. Yeah, it's been another busy period, and so I'm hopefully getting a little bit of a breather here to where I can start posting some more videos. And I see that we've had a number of new subscribers here too, so it's great having you here. And one of those subscribers had talked about in a recent post about backtesting. And this is a topic that I get a lot, especially with all of the computing power that we have these days and the ability to access all kinds of data. And so the question that I wanted to explore here today is, does backtesting really work? And on one hand, it's the best that we have. That's really the whole basis for statistics. We don't have a crystal ball, but we can go back and see how things have performed in the past and maybe extrapolate that and say, can we expect this in the future? And it's something that a lot of traders like to do, and I'm not trying to discourage anyone from doing it, but I just wanted to point out for all of you who are doing any type of backtesting, there are a lot of weaknesses, lots of drawbacks. And so what I wanted to do here was to explore some of these drawbacks, certainly not all of them, but just to give you a little bit of a better background of the things to be cautious of and why you have to be very careful about the conclusions that you draw. So let's go take a closer look. Does backtesting really work, and is it going to be worth your time? And as always, before we do, please be sure to click like and subscribe. It is greatly appreciated and helps so much to promote the channel. So first off, what is backtesting? Well, it attempts to determine a strategy's potential future performance by seeing how it performed in the past. As I mentioned though, sounds good on paper, but there are many limitations. And so the first thing to understand is that whenever you're doing any type of a statistical test, pretty much all of them assume some type of stationary process. They are assuming that, let's say, that the number of cards in the deck doesn't change and that we're not getting alterations to the rules and things like this. Virtually all statistical tests assume randomness and independence. Randomness just means there's no rhyme or reason to the things that we're drawing. Independence means that the observation we got was not influenced by a previous observation, nor will it influence a future one. So for example, any type of statistical test that you might do from a deck of cards is a classic type of thing where statistics is really powerful. If you're trying to figure out what's the probability for a full house, sure, do some back testing. You're going to get really, really close. And the math behind that and the answers behind that are not any different than they were 100 years ago. So that's something where we can get randomness and independence, and we've got a stationary process. What about tests from coin flips? Same idea here. If we get ahead, it was not influenced by the previous flip, and it does not influence the next flip. So this is what most of your statistical tests are going to assume. But as we're going to find out, this is not at all how the stock market works. But before we do that, let's go to an Excel demonstration and take a look at a distribution of coin flips. Okay, so now we're into an Excel spreadsheet, and I've created a little simulation here for 100 coin flips, but we've just repeated it many, many times. And so I think most of you know we should get roughly 50% heads, 50% tails. So for 100 flips, we would expect roughly 50 heads. And look at this. The tallest bar right there in the center of our bell curve, we're showing about 50 to 52 heads. The next tallest bar over here about 48 to 50 in these intervals. So we're getting really close to figuring out that it looks like 50 heads would be a pretty good guess for 100 flips. But what if we did it again? And there we go. Looks like we got, again, somewhere around 50 heads right here in the center. We run it again. Look at that. Always finding out that that answer of 50 seems to be right there in the center. Now, is it always a perfect distribution? Not at all. You can see that if we had hundreds of people doing the identical experiment, they're all going to come up with a little bit different data sets. But they should all come up to reasonably the same conclusions, that it looks like we're getting about 50 heads and 50 tails for 100 flips of a coin. But you can see even in a stationary process like this, there can still be some variation. So that's the first thing to observe. They're not going to be perfect. And yet that's what a lot of people assume. Hey, I went back and looked at the last 6 months and I saw that 70% of the time this happens, and then they assume that that's going to continue. So you can see that the first thing to remember is that there's a lot of variation in a random process. But my main point here was to show that we are at least coming up with the same conclusion, even though there's a lot of variation. But now let's go back to the presentation and see the limitations for the stock market. All right, so with that little background, what's the first limitation that we have if we're doing experiments or backtesting with the stock market? Well, the biggest one is that the stock market is always changing. So the ability to make predictions, such as from decks of cards or from coins, depends on having many similar experiences in the past. Well, that's not at all what we get with the stock market. We have everything changing every single day. But at a minimum, over time, we've got changing volatility. We were at 85% during COVID, closer to 90% during the crash of 07-08, and yet right now we're below 20, so we're below average. So your answers are going to be very different depending on the volatilities. Why? Because that influences prices and that influences traders' decisions. We also have changing interest rates, and that's going to change risk calculations. We have lots of little tiny rules, like the uptick rule has been in and out of effect through the years. And so this is just a very small set of the potential problems. But because all of these things are changing, it's going to throw your numbers. And for instance, correlations can be greatly distorted. This is one that I hear a lot of traders talking about. They say, oh, well, I did a regression and my R squared was really high. Well, that doesn't really prove anything. So for example, here's a kind of a U-shaped function, a parabola that many of you would recognize from math. And notice that the correlation is going to be very low here, almost non-existent, but there's a very strong association. I think everybody would look at that and say that that's not random, but the correlations are going to be very low. There's also another problem with correlations in that everybody assumes that if the correlation is positive and high, that everything moves together. One moves up, the other moves up. And that's sort of true. So for example, let's say that we have a series that's doing this with an uptrend. We have another series that's doing this. Well, I think most people would agree that those are very different. But take a look at the correlations. When this series was going up, this one was going up. When this one was going down, this was going down. This was going up, this was going up. And so you can see that they would be highly correlated. And again, when it was up through here, they seem to be moving together. So your correlations are going to be very high, but look at the path. It's diverging. So they're actually very different outcomes, even though the correlations might be positive and be very high. And that could obviously throw you in the complete opposite direction of where you think you're going. So correlations are just one of many of the statistical results that people use that can be easily thrown because you're not using a stationary process. Let's take a look at limitation number 2. Sample sizes, especially for annual projections, can get very large. I've had some traders that say, well, the market has returned X percent in these periods or for these years, and therefore this and therefore that. Well, to have a 5% margin of error, which means that if you find that the truth is, or the result anyway, is 70%, it's really more like 65 to 75%. That's what we're talking about, a 5% margin of error. And in order to have a 5% margin of error, you would need 61 years of data. If you want a 1% margin of error, it would take about 1,500 years, longer than the stock market has even been in existence. And so right there you're saying, all right, if you go back 2 or 3 years, considering all of the things from limitation 1, how much confidence do you really have in this conclusion that you're coming up with from the backtesting? Well, hopefully you're starting to see right now it shouldn't be too strong. Let's take a look at limitation number 3. So this is a big one, and I've talked about this many times in previous videos, But if a pattern does exist, well, that's great. Well, price will reflect the advantage. So remember that price is the equalizer. And if everybody knows about this pattern, and you can be reasonably sure that that's true, if you've detected it, trust me that Goldman Sachs, JP Morgan, all of the big firms out there have also detected it. And all it's going to take is one big firm to detect it, and then that's going to be weeded out. Price is going to reflect it. And so if trades are priced at fair value, well, now there's no benefit. It doesn't matter if there really is some type of an association. So in other words, the profit motive eliminates predictability. So we've talked about this before. I've used this example. Let's say that we throw 10 numbers into a hat, and we're going to draw them out, and you're going to win if you pick the numbers 1 through 8. All right, well, you've got an 80% chance of winning. And you might say, hey, that's great. Think of this as your backtesting. I have figured out that 80% of the time when something happens, whether it's a gap fill or an engulfing candle or something, that we get this kind of a result. Well, if the market has priced that in, this is going to be your profit and loss over time. At fair odds, you're just going to break even. So if you have an 80% chance of winning, you're going to have to pay $4 to make 1. So if you have an 80% chance to win, you're going to have to pay $4 to make $1. And that's another way to say that the odds have been priced in. In other words, you have no advantage. So that's probably the biggest one. And so if you are detecting what you think is any kind of a potential pattern, then it's obviously not at 51% or 49%. It's something that's relatively easy to see. 60% of the time this happens, 75% of the time this happens. And if it's that big, trust me, others have found it too. And that means that that discovery is probably worthless because if everybody knows about it, it gets factored in. So my idea here was not to discourage anyone. I think it's a cool idea to go back and try to backtest. But instead, it's really just to warn you for all of the traders who think that you are backtesting that you're probably fishing in a very large sea where there are far more potential risks than rewards. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new candlesticks and technical analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.